No, now we're live. I see live and there's a countdown. So I can't see who's all joined us here, but I know we had a lot of registrations. I think we are at like about 500 or 600 registrations.
Wow.
So it'll be a good turnout. And thank you everyone for joining us. We love doing these things. I wish I had more time to do more of them, but it is what it is. I think everyone's anxious to know what we're seeing in the markets. And I know I'm really excited to hear what you have to say, Adam. So let's jump into it. But for those of you who are watching and can't stick around, hopefully you can. We're going to do FAQs at the end. But if you can't stick around, we're going to be recording this and we'll send out a copy of this tomorrow as well. So let's jump right in. All right, so the agenda, we'll just do some quick introductions and then we'll jump into you're my guest here, Adam, and I know a lot of people want to hear what you have to say, and I'm really excited to hear what you have to say. But I think it's good to kind of go through context, how you've helped me achieve what I've achieved through investing and how you've helped a lot of my clients achieve it. So I always like to start just going through like at a really high level, what I do and how this all applies to real estate investing and how you fit into everything. So we're going to start with the investor operating system, and it's essentially a step-by-step process I've used to build $100 million portfolio. Power of leverage, time value of money, compound interest, earning money while you sleep, iOS in action. I'll show you guys an example of something I'm investing in actually this week where I'm applying these principles. Why pre-construction condos? This is the main asset, real estate asset I've used to build my portfolio. It's an easy hands-off way to create serious multi-generational wealth, which we'll get into when we look at my portfolio. And then we'll talk about some other investment opportunities that are available in the market. And then you're going to take over, Adam, and you're going to give us all of the insight into what's happening in today's new mortgage market. Interest rates, where are they and where do we see them going? Inflation report. So I can't wait to hear that. And what does this all mean for real estate investors? And, hopefully we'll talk at some point about the deals you're helping me out with, because we just got two appraisals done on two properties that, I just bought two assignments, and I'll talk about it a little bit later on in the presentation, but I pretty much used the other person's deposit. I bought the assignments, put down their deposit, bought it at their original purchase price. And then you're doing the refinance for me where I'll almost get all of my money back. And then own a condo at the same time. And that's a very short period of time. So there's still some really, really good opportunities out there in the market today. And then we'll get into Q&A. So whoever sticks around, we love hearing your questions. Adam, why don't you introduce yourself?
Hey, thanks, Ryan. I thank you for inviting me back again. I always love the opportunity to speak to your clients. For those that don't know me, my name is Adam Bazuk. I'm a mortgage broker with Dominion Lending Centers. I love Italian food and long walks in the park. No, I'm kidding.
This kind of looks like your dating profile. This could be like a picture or something.
Only I still look like that photo. Anyways, I've been a mortgage broker for about 20 years, and over.
What year did you start?
2001.
Okay, I started 2004, so not too long after.
Yeah, 2001 for me. Just the way it worked out, I've just spent a good part of my career working with real estate investors, and I love working with everything from first-time home buyers, right through to a much more sophisticated investors, such as yourself, with multiple properties and helping them plan out the portfolios from a mortgage perspective. I still very strangely love mortgages and trying to figure things out. But again, I really appreciate the opportunity to be here. Thanks, Ryan.
Yeah, well, thanks for being here. It's always great to chat, and you've helped me a lot with my portfolio and a lot of my clients. So thank you. Most of you know me, real estate investor for 20 plus years now, 15 plus years as a real estate broker, founder and owner of Connect.ca, Marco Toronto, One Day Money, top producing real estate team. I've got an incredible team, doing a lot of deals, access to all the top developments, and get our clients access to the best opportunities. I've got a portfolio of 40 doors and a value of today's value of $33 million, which we'll take a look at. Connect Group of Companies, Connect.ca Realty. My investment is a boutique investment brokerage that works mainly with investors through pre-construction condo investing and other investment properties. Marco Toronto is my property management division, which has over 200 properties under management. We manage most of our clients' units, including all of mine. Real estate is very simple for me. It's completely hands-off. And for many of our clients, we manage all of their units as well. And we try to make owning real estate as easy as owning a mutual fund. One Day Money is my private lending division, where we help investors tap into the equity. Someone who bought a pre-construction condo 5 or 6 years ago, when they go to get a mortgage, they get a mortgage on the contract price. One Day Money allows them to get a mortgage, first mortgage, 30-day mortgage on the appraised value, which allows them to tap into their equity to pay closing costs, further deposits, or to have money in the bank account. And then they get refinanced by someone like Adam to come in and get more traditional financing. One Day Assignments is, we help people liquidate assignments at the contract price so investors can quickly retain their original investment deposits, so people don't lose money, but it allows more liquidity in pre-construction, which pre-construction doesn't always have. So the Investor Operating System, iOS, this is an easy, hands-off, step-by-step system for creating multi-generational wealth. Something just popped up on my screen. I don't know if you guys all see that. Live viewer comments show up. Okay, I hope we get some comments. I don't see them though. Okay, so the tenets of the iOS are leverage. It's simple. Like, what makes a really good real estate investment? Leverage, compound interest, time value of money, passive income, and then the process. So the process we help our clients with, and myself, is buy pre-construction and wait. We help you get financing. We help manage the property for you. We help you use your equity to refinance, reinvest, and then repeat. This is a way to create incredible wealth, multi-generational wealth. And when I say multi-generational, I'm talking serious wealth that can be passed on to the next generations. And it's a way of doing it with minimum time, energy, and effort. And it's not buying crypto and making a fortune overnight, that's for sure, or losing a fortune overnight either. This is a slow but very, very lucrative and safe way of building serious wealth, which you'll see. So the power of leverage, you guys probably all know the term OPM, other people's money. So the traditional way of looking at real estate leverage is when you're using the bank's money. You're getting a mortgage, you go to Adam, he gives us a mortgage, or the bank gives us a mortgage through Adam, and then our tenant pays back the mortgage. Other traditional ways of leverage as well could be applied to investing in stocks, but that's usually only available to high net worth people. It could be called on very quickly. Leverage with real estate is a safe and lucrative way of doing it. Pre-construction is the ultimate leverage. So what does that mean? So you can invest without a mortgage. So I'll show you an example where I literally did put down 5%, $100,000 on a $2 million property, and I will get 8 years of appreciation on leverage, which is a very, very powerful thing, especially once you factor in all the variables, time and compounding. By the time you take out a mortgage, you have price and rent appreciation, which usually equals serious equity and allows you to redo it. It helps you to create passive income. So what is passive income? It's income while you sleep. It's passive. It's not getting your hands dirty. It's not doing any heavy lifting. It's passive, and it gives you freedom. I mean, that's why I got into real estate. I wanted to create my own pension so I could retire and have the freedom to do the things I want to do. And most of you real estate investors here probably are familiar with Robert Kiyosaki. He famously said, leverage is the reason some people become rich and others do not become rich. Pretty simple, straight to the point, but it's real. So time value of money, $1 invested today will be worth a lot more money in the future. So time gives you, in real estate, it gives you compounding, but it also eliminates your risk, because when you're buying potentially for the short term, you could be exposed to volatility. You could be exposed to what's happened to different markets across Canada over the past year or so. And that's really, where it gets risky, when you want to make money quick overnight. But when you're buying for the long term, essentially all of your risk, evaporates. I don't want to say that, but for the most part, when I buy something for the long term, I don't see any risk in it, right? So this graph is great. This puts it in perspective what I'm talking about. This is the Toronto Real Estate Board average home price starting in 1977, which was 64,000. And then today, the average home price is 1.19 million. So, this is modest growth. And if you look at here, this is 6.69% compounded annual growth over 45 years. So within that 45 years, you've got the dot-com bust, you've got the 90s crash, you've got the 2008, financial crash, you've got up and down markets. And if someone, I feel bad for people that wanted to get into the market at any point within the last 45 years. And they said, prices are going to go down. Prices are going to go down. They probably are going to be right every once in a while, but they're wrong when you look at it over a longer window. So, put the return and the IOS in a little bit more perspective in this example. 20% of a $64,000 house, 20% down payment is $12,000. $12,000 invested 45 years ago in Toronto real estate would be worth 1.19 today, which is a 9,000% return on investment. That's an important number because I use these historical numbers to make forecasts of the future. Now, you're doing, what's that?
9,000%, not bad.
Not bad, eh? I think that might be, going up with Warren Buffett there. It is when so from a return on return comparison, it doesn't compare with Warren Buffett because it's 6.69% per year. But when you factor in the leverage, which you wouldn't take leverage on a Berkshire Hathaway stock, you probably couldn't even get access to it. So you actually would do better investing in real estate than investing 100% of the capital into a Berkshire Hathaway share, right?
Crazy.
So if you're doing nothing with your money, you're losing it. I think this is really important to talk about right now because a lot of people are waiting on the sidelines. And, my past example, it's like if you're thinking the money's going to go down or the market's going to go down, you're timing it. Real estate actually is a hedge against inflation by outperforming over the long term through capital appreciation. I'll talk a lot about capital appreciation because that's what's most important. So in this example, $100,000 invested today over a 5-year window, using a 7% inflation. I think it's lower now and it's going to be lower, but for the sake of an example, 100,000 today would be worth 238,000 in 5 years. So that's putting 100,000 in real estate, a deposit on a condo, thinking only 5% compounded annual growth. Now, that doesn't matter if next year's zero, doesn't matter if the next year's another zero again. There's going to be fluctuations in that 5 years, but what I'm very confident in, a very conservative way of looking at it, is 5% compounded annual growth is still going to make me 138,000 by investing today in real estate. Conservatively speaking, the same money sitting in your savings account at 2%, you're going to lose about 30,000. Same money sitting in your savings account earning no money, you're going to lose about 30,000 as well. So the miracle of compound interest. And I love this example because, again, this shows you leverage and kind of ties all these principles together. So the Toronto Stock Exchange, which did quite well, the 5-year average compounded average is 6.6%. 10 years, 5.7. When you look at over 15-year average, 3.6, a lot of volatility there. When you look at the 20-year, it's 5.2, okay? So what that means, if you put $100,000 investment in the TSX 20 years ago, that would be worth $275,000, 176% ROI, not bad. But when you factor in compounding interest on interest when you've got leverage and interest on leverage, the numbers just get drastically bigger. So, for a comparison, apples to apples, the GTA condo market saw 11.1% 5-year annual growth, 10-year 8.8, 15-year 8.7, 20-year 7.6. So about 2.5% more over the 20 years than the TSX. But when you buy real estate, you buy with leverage. It's very easy to get leverage, sometimes easier than others, but you typically buy real estate with leverage. So $100,000 investment just in condos with 100%, no leverage would be worth 432% 20 years later. So much better than the real estate or the stock market. But once you factor in the leverage, putting down $100,000 would be on a much, a $500,000 property back then, 20 years ago. That same property would be worth $2,163 today. So it's a 2,000% ROI. And that's leverage. Like this isn't me forecasting. I'm telling you what just happened. So this is what happens in real estate when you use the principles in the iOS to make money. And Albert Einstein famously said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. I think that applies to all things in life, compounding, habits and routines, but especially with money and investing. Passive income. So earn money while you sleep. I remember my grandpa when I was young, he would always say, figure out how to earn money while you sleep. And he would always say that. And then many of my family members were teachers, and my mom was a teacher. And they'd always talk about their pension and summers off. So I was always thinking about, how can I create my own pension? How could I do it? How can I scale and do all these things? And real estate just became the most, I think the easiest, most understandable way to do it. You didn't need the education necessarily. You could just go and figure it out. So, I use pre-construction condos as an easy, because I see it as easy as owning a mutual fund. So pre-construction is very hands-off. You're putting down a deposit on a highly appreciating piece of paper. You're putting it in your filing cabinet, and you're forgetting it for 5 or 6 years. Okay. So you've got all of that. That is the epitome of passive. So you're getting appreciation on leverage on something that's sitting in your filing cabinet. Passive income, hands-off investment that earns money while you sleep. Now, to put this in perspective, I'll say here, so multiple properties equals multiple streams. And this is what's really important, because you want to have multiple streams of income to build wealth. Any wealthy, successful person, book you read about how to build wealth will talk about multiple streams. Now, you can work multiple jobs, but no one wants to work 10 jobs. But if you have 10 properties, you've now created 10 different revenue streams for making money. So multiple properties equals multiple streams of passive income. You can't work 10 jobs, but you can own 10 condos. The average income in salary in Canada in 2021 was $54,000. The average condo price is currently $710,000. The average, 10-year appreciation 7%. That's $50,000 increase in your net worth every year. You're making as much money nearly as the average Canadian by owning one bedroom condo. Once you have 10, this is why you start seeing what I'm about to show you, how this really escalates and you build a lot of wealth. Warren Buffett, again, if you don't find a way to make money while you sleep, you will work until you die. That's pretty morbid, but it's true. Refi, buy, repeat. So this is kind of the full cycle of how we use this process to build serious wealth. And you're really tapping into your equity as cash flow, and you're using the equity to create wealth. Equity in your property isn't working for you if it's sitting there. Make it work hard. Most Canadians are sitting on a mountain of cash in their primary homes, which can be used to build wealth, which Adam helps a lot of our clients do, and including myself. It's way easier to turn equity into cash flow versus slowly investing for cash flow. You know what I mean by that, Adam. So, you could buy a property today that has $500 a month in cash flow, but if it's not seeing the equity appreciation, it's going to take you a long time to really be able to have the freedom from real estate to do the things you want to do. So what you help me do is you're several times throughout the year, you're helping me refinance my portfolio, where I'm pulling out hundreds of thousands of dollars, and I'm using that as my cash flow. And it doesn't happen overnight. There's an inflection point. Once you've got a portfolio, you bought 2 properties at least, and they're 7 or 8 years in, you're going to have a constant turnover of huge amounts of money. That is your new cash flow. And that's the way to do it, because then you're taking out cash flow, but you're keeping the properties. And this is where we look at refinancing as the best tax avoidance strategy to ever exist. So what do I mean by that? I just pulled out, over $1 million this year through refinancing my portfolio with Adam, or last year, I should say. I didn't pay any tax, no tax. So if I had sold the properties, I would have paid a capital gains tax, and I would have been left with, probably even less money in my pocket. But this way I keep more money in my pocket, and I keep the property, and I go repeat. And then on top of that, which is just crazy to me, is that it's a tax deduction. So I'm taking that money and it's actually reducing my taxable income, which is amazing. So I have negative cash flow this year in my portfolio because of the variable rates. My income is probably going to be, pretty flat. And I've taken out, over $1 million in 12 months to go redeploy in other investments.
And your tenants are often covering the tab.
That's right. Yeah. And that's how I've turned one property into 40 with the multiplier. And I'll show you guys that shortly. So the iOS in action, this is a 3-bedroom condo I just bought this week, actually, in Forma Condos, downtown Toronto, landmark building. This was a 5% deposit, which is usually a really good idea, especially when the project's 5, 6, 7 years out. It's almost always a no-brainer. So to put this in perspective, I paid 1.9 roughly, put down 100. I got leverage on 1.8. So if the market goes up 5% a year, I'm getting income off of the developer's money. Essentially, I'm not taking out a mortgage. I'm putting down 100,000. I'm getting interest on my 100,000, but I'm also getting it on the leverage, which I'm not paying for. Now, this is what I look at when I break down the numbers. I'm like, does this make sense for me? I look at the capital appreciation. I look at the timeline. I look at all of the elements in the iOS. So real estate doesn't need to be difficult. Make real estate simple. These are the things I look at. You know, leverage in this example is 94,000, mortgage free to buy a $1.8 million condo. The time value of money here, minimal risk. It's 7 to 8 years of rental growth, price appreciation before I actually take on risk and take out a mortgage. So I'm looking at, years to completion here, at least 6. I think this is actually going to be 8, just based on the complexity of the project, the architecture and design. And the annual rent increase, I've used a very modest 5%. It's averaged over 5% over the last 20 years. And that's with COVID that tanked it. It'll probably be closer to 6. Annual price appreciation in this example, very modest at 5% based on all of the supply shortage issues coming. I think it's going to be considerably higher, but even given this example, when I actually close on this or assign it, I'm looking at a profit of $635,000 from a $100,000 investment. Okay, so I like to look at it that way. I like to look at it conservatively. Then I like to look at it what it probably realistically will be. And I do this every time I buy an investment, and anytime I like looking back when it actually closes, and I compare what I forecasted, and it's always been higher. Because I do take a somewhat conservative approach, and some of you may not believe this because the numbers are so big, but this is how I do it. So compound interest, we'll look at a 25-year growth story. Earn money while you sleep. Pre-construction, as I said, is easy. In this example, I'm using 8 years to completion because this is what I actually believe it will be. I'm using the same rent appreciation, and I'm using just 7% annual price appreciation. That could be higher. It probably will be. Based on that, I'm pulling out 1.4 million in equity when this is done. So this is when I pick up the phone, I put down the rest of the 15%, the closing costs. I call Adam as soon as I'm about to close this. I close, either with a big bank and have Adam come and refinance, or I close with Adam and then we refinance a week later, and I pull out my equity, and I pull it over $1 million in this case, and I go redeploy that. I put that into more real estate without paying any taxes on that. So why pre-construction? Already touched on it, but it allows you to start with one and just watch it grow. It's really easy. It's hands-off way to create serious wealth and multi-generational wealth. Allows you to invest without a mortgage. I've said it before, I'll say it again. The ultimate leverage, do more with less. You can get deals of 5 to 10% down and nothing for 5 years. Typical deposits, 15%. Passive income, as easy as owning a mutual fund, and scalable way to create multiple streams of income. That's really important piece because, it's difficult to scale companies and investments and different types of real estate. This is a very scalable way of doing it. Newer condos outperform older condos. Time equals money, reduces risk. So it's a very risk adverse way of doing it, in my opinion. This is an example of the multiplier effect. The average condo today is 710,000. You put down 140,000 in 6 years based on 7% annual appreciation. You would refinance property 1 with Adam, then you'd pull out 199,000, buy property 2. You'd have 30,000 left over. You put another 169,000 in. So in total, you put about just over 300,000 into this portfolio that I'm showing you here. And this is a very historical way of looking at it, based on historical numbers. And then in year 12, you'd refinance properties 1, 2, and 3. You'd buy properties 4, 5, 6. And then you would just wait it out. And in 25 years, you'd have a $20 million portfolio, and you'd have equity of $15 million. Those are real numbers. I'm just simplifying it to show you guys how this all works. And this is a real life example. So Adam did this deal. I don't have the new one that you just got the appraisals for 2 of them for me today, but this is one we did last year. Purchased in 2017 at 602,000, appraised last year at 1.175. currently renting at 3,800. The mortgage at the time was 482. You refinanced 80% of the 1,175,175, which gave me 940,000. We paid off my old mortgage of 482, and that left me with 457,000. So that 457,000 is what I went and bought a few assignments with, and I'm doubling down. I'm taking advantage of the opportunities in the market. Now, this is my portfolio. So this is, this is a pretty busy screen. So let me walk you through it here. But this is really putting my money where my mouth is, and looking inside the real life example of the multiplier. These are all my properties. $35 million market value today. It was 37 million last time we did this, Adam. But that's the market, and I don't lose any sleep over it. I'm in this for the long term. I expect this to happen, in fact. Yeah. And whether that happens tomorrow or a year ago or in 2 years, doesn't matter, because I know what's going to happen over the long term, right? So current value, if I just did 4% compounded annual growth, this is leverage and compounding, in 20 years, that would be a $74 million portfolio. In 25 years, it'd be 90 million. And just 5 years later, it'd be 110 million. That's 4%. Now, given the huge amount of immigration coming to the city and the huge amount of supply constraints for new building in the GTA, I expect that number to probably be closer to 7.5%. And to give you an idea of the difference, in 20 years, I'm talking about 144 million. In 25 years, 207 million. In 30 years, 298 million. And this is the iOS. That's leverage. That's compound interest. That's time value of money. That's multiple streams of passive income. That's refi, buy, and repeat. Again, it isn't about timing the market. It's about time in the market. And I love this because this is really important, because I know everyone talks about cash flow. Grant Cardone's like, cash flow, baby, cash flow. But, to an extent, cash flow is very important for some people who want certain things. It depends really what you want. If you want to build serious wealth, you don't buy real estate focusing on cash flow. You buy it focusing on appreciation. That's where the real money is. And that's the example I've used here of my portfolio. And, capital appreciation is king. Pre-construction gives you the safest and easiest access to capital appreciation. And then one last slide here. So this is the slide I used for the Toronto Real Estate Board, showing you from 75. If I use the exact same compounded annual growth for the next 45 years, 45 years is a long time, but I'm talking multi-generational wealth now. So I'm giving this, family trust to my family. $35 million portfolio today, and 45 years of history repeats itself. Nothing new, just if it repeats itself, it's going to be worth $663 million in 45 years.
Well, you'll only be 65 in 45 years, Ryan.
I wish. I mean, I'm trying to do some biohacking stuff. I don't know if I can. Look, I don't. You know what? My plan is to live 1 million hours, and that's how I kind of measure my time and energy into different ventures and life and decisions. And guess how many years that is? 1 million hours.
Well, I need to get out my calculator.
It's 114 years. So that's my goal.
114. Okay.
So I'll still be able to spend this money in 45 years. So look, this went a little longer than expected. Sorry, Adam, but let me just some examples of what's in the market today and where I'm buying and some of my clients. And then excited to jump in and hear where we're at with the market. So blue chip, I look at Toronto as a blue chip market. The REITs buy buildings in Toronto because it's very predictable growth. It's capital appreciation growth, right? So it's a more stable market offering long-term security, typically demand the highest rent rates, low supply, high demand markets. Forma Condos is just a stunning building, 2 buildings. But Tower 1's on sale right now. I think there's incredible value in this project. I know there were buyers buying from all over the world. It's recognized all over the world. It's a Frank Gehry designed building, who's one of the most famous architects in the world. And that's realistically 8 years away. And I could probably still get a 5% down deal for someone if they want it. That's an incredible deal. Alias is another just stunning masterpiece building, beautiful architecture and design by Madison Group, an incredible developer. This is downtown in the financial core at Richmond and Church and Yonge in that little pocket. They're doing 5% down. So they've got a bunch of units with just 5% down, nothing else. It's realistically 4 years out, but we sold a bunch in here, and there's still some really great units. Now, I like to look at value plays as well, because I'm investing a lot in Hamilton. And what I mean by a value play is it's maybe a little less predictable than Toronto being a blue chip, but there might be some more upside. So right now in Hamilton, you got a ton of revitalization money coming, billions of dollars in all levels of government. They're revitalizing the waterfront, the downtown core. You're seeing jobs coming. You're seeing transit. You're seeing, it's now connected directly by train to Toronto. So, you're paying 40% below Toronto prices, but rents are only 20% below. So that's a cash flow market. So I also think there's a lot of upside on the appreciation side, and I've got a lot of condos there now, and I actually have quite a few threeplexes as well. So these are two really great projects. 5% I can get here. This is 5 years out. 5% deposit. That's it. Television City. You could buy a condo for $25,000 right now and do nothing for 5 years. This is a remarkable project. Just going to be a landmark building in Hamilton, next to St. Joe's Hospital, next to a short walk to the City Hall and one of the campuses for McMaster. Great opportunity. So key takeaways: pre-construction condo investments are the best and easiest way to build wealth. Easy hands-off way of creating serious wealth, multi-generational wealth. Invest without a mortgage. If you're investing money, you are actually losing money with inflation. If you aren't investing, I should say. We've been doing it for 20 plus years, and we've built the foundation for our future generations by using the IOS. Compound interest means the earlier the better. Time in the market versus timing the market. If you do nothing, you are losing money to inflation. And my favorite quote of all time by a wise little Yoda: do or do not, there's no try. I don't think you guys should be waiting on the sidelines. I think you should reach out to our team, reach out to Adam if you want to access equity to do things, and you should be taking advantage of some good opportunities. So Adam, I went a little bit longer than
No worries. I can, how do I follow Yoda? You make me follow Yoda? Are you kidding me?
Well, you kind of got like a Clark Kent thing going here. I mean, he's like, cool, Superman. There you go.
Your slides are unbelievable. I think some of my first few slides, you're trying to throw me under the bus and make me cover all the negativity that's in the news. But all kidding aside, I have a pretty positive outlook on the whole thing. This slide here honestly just covers quickly what a few of the things I'm going to touch on. I just wanted to talk about a few of the key factors in the economy, and what the impact's been on the mortgage market. Some of it's pretty obvious. What does this mean for real estate investors? A lot of people on this call. And then just a snapshot of a few of the strategies and planning things that we're doing for some of our clients. Next slide, please. Okay, so as I mentioned, I'm gonna show a bunch of slides here: the housing market, inflation statistics, mortgage rates, the labor survey. I really actually do think Ryan's making me out to be the bad guy here. But honestly, after doing this for, like I said, over 20 years, I honestly think that real estate investors can find success in all markets. Ryan has been speaking to that just now. And you have to take with a grain of salt a lot of what you read in the news or watch or hear on TV in the news. Nevertheless, some of the current housing market statistics are a little alarming. And in short, new listings are down, home prices are down over last year. Sales were slightly up in December 2022, and total transactions were down 39.1%. So this was, big in the news, the report on December. And they were quick to point out that total transactions were well below the 10-year monthly moving average, yada, yada, yada. Now, all of this housing market stuff versus the previous year was probably due to a whole lot of factors. I mean, and some of them we've seen before. First of all, sale price shock. There's a lot of people that were with what happened to housing prices between spring 2022 as we rolled into the summer. They couldn't believe it, and they didn't want to do anything. Historical which I'm going to touch on, a historical interest rate increase, or speed at which it went up, inflation and uncertainty, global issues, all these things. But if you want to go to the next slide for me, Ryan.
Yep.
And actually, you can skip right over that one too.
That's interesting though as well though. So because I think what you found here is that so listings are also down. So listings are down significantly, sales are down significantly, but in some markets, it's actually, kind of balanced market. It's in a balanced market somewhat, right?
Yeah. And, my favorite part of this slide here with read the housing market, everyone seems to be worried about house prices. And notice the line on the left-hand side in the middle. Even with these large declines, prices remain roughly 33% above pre-pandemic levels. There is still a lot of equity there. That's why I loved how I didn't know you were going to say this, but how you mentioned the value of your portfolio, what was 35 million right now, and back when we did this in the spring, it was 37 million. And you're like, who cares, basically. What this is saying, and our chief economist at Dominion Lending puts these statistics together. If you bought a property in 2019, you have still had a 33% capital appreciation between then and now, 33%. However, everything in the news is, oh my goodness, house prices have dropped, immensely, but they're fixated on a peak that happened, by February 2022. So it's just interesting, and I like to focus on the positive. The long hold in real estate is the way to go, as you mentioned.
Yeah, well, I mean, that's I've said it so many times, that's really what takes the risk out of it. And it's important to look at all of the data, right? When you just look at, year over year or month over month, it doesn't always tell the whole story. It's good to look at all of it because, people talk about how much it's down from the peak, but, like you said, how much is it really down year over year and over a longer period of time? And it's not all that bad. I don't want to sugarcoat it. Some people got caught at the top of the market, and hopefully they're not speculative investors that are trying to make, money overnight, but they're going to live there for 5 years, or they're going to invest into it for the long term, and they're going to be okay.
Yeah. I mean, that's what I always tell people. And you just summed it up beautifully. I mean, if you purchased at peak, but you plan on living there and you're going to be making your mortgage payments and yada, 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 it doesn't really matter that your house value has come down temporarily. Over time, it's going to go up. Oh yeah, interest rates.
What's going on here, man? Because I can't wrap my head around this.
Yeah, no one on this call is interested in what the heck's going on in with interest rates.
Yeah.
I've fielded so many phone calls over the past year. I almost want to phone the Bank of Canada and yell at them directly. But I mean, obviously, rates have been going up, up, up. And I'm going to touch on it in detail in a couple more slides. But it was finally in June. Oh, and the one thing I wanted to touch on, which you're going to see, is even economists can't completely figure out what's going to happen here. And we just need to trust historical data.
Right.
And it never lies in what's going to happen. But on the next few slides, we're going to hear that finally in January 2023, we witnessed the Bank of Canada increase their policy rate by another 1/4 point, which affected prime. And all indication was that there'll be no more increases in 2023 based on a number of factors, and that rates will start to come down again around mid-2024. It's important to note that before we move on to the next slide, that I guess this was good news, one more 1/4 point increase, but rates had gone up at a historically unprecedented pace. So bank prime had never gone up as fast as it did between roughly March or April 2022 and January of 2023. prime was 2.45 back in the spring, and it's 6.7 now. No wonder there's been a little pause on some things as we ponder what just happened.
Yeah, I almost remember like it was yesterday. The governor, Bank of Canada, just saying that interest rates are going to remain at all-time lows for the unforeseeable future, well past, I think he said 2024.
Yeah, mid 2024. So next slide, please. Oh, no, back a slide. My apologies. Didn't know yet. Oh no, bottom line. Sorry. Yeah, next slide. Sorry, Ryan.
Yeah.
So a few other alarming things on this slide. For me especially, which I actually couldn't believe this, but before I talk about that, I just wanted to briefly touch on, you see on a lot of these articles, they talk about the policy rate and being 4.5%, and the Bank of Canada's policy rate is what then, just so everyone understands the difference, it's what then the banks base their bank prime rate on, and it's usually about, well, it's always 2.2% above the policy rate. And so if the policy rate's been increased to 4.5%, we're at 6.7% prime today, which is what your home equity lines of credit and variable rate mortgages are based on. Fixed rates have a mind of their own. They're based on other things like bond markets and all that jazz. And in fact, they came down a little bit in December and January. But who knows do you know what the Bank of Canada's target policy rate is? Like if inflation is in line and where they ideally love to see their target rate, you know?
The inflation or the mortgage target overnight, or
The target policy rate
no, what?
is 2.5.
Okay.
So that would actually make prime 4.7.
Okay.
And over my career in this industry, a prime, around 5%, prime at 5.25. This was normal. Fixed rates in the 4s and 5s. We've sort of been spoiled rotten for a couple of years here, and I just think when we talk about rates are going to start to come back down again in mid 2024, we need to sort of take all that with a grain of salt and come down from where and to where, in the foreseeable future. Never say never because it happened, but I don't know if we're going to see 2.5% interest rates on mortgages again for quite some time.
What are you suggesting for people right now? Are you telling them to get variable rates or fixed rates? I mean, I know obviously it depends on the person and if they want to sleep better at night with a fixed or whatever, but like what do you think?
Yeah, like most of my peers would agree with me right now. Fixed rates are, so if you're in a variable rate mortgage with a good discount, and there's a number of factors that follow it, maybe you're probably going to stay in that and ride it out. But if you're negotiating for mortgages right now, fixed rates are probably a wiser move. Now, how long? 2-year, 3-year terms or 5-year terms, that's the debate. But fixed rates are well below variable rates right now, and so that gap makes it probably makes a fixed rate more attractive.
I think also because we expect rates to start coming down later this year, maybe into 2024, instead of them potentially going up in the short term, lock in. So I've been locking in for 1 year fixed. I mean,
Yeah.
I still have a lot of variables, but my new ones I'm doing 1 year fixed, and then I will switch back to variable.
Shorter term fixed rates are very popular right now, and I can't argue the logic. And it depends on how you feel about where rates are going to go over the next couple of years. Not a lot of people taking variable rates right now.
What do you see in terms of 3-year fixed and 5-year fixed? Like, what do those rates look like right now?
Like 3-year fixed rates on conventional, like on investment property purchases, are in the low 5s right now. There's some 5.25 maybe on the 3-year. So this slide here, I mean, was taken from the press in January. Okay, this is the irony of the whole thing. And you'll notice in the middle there, it says no rate hike is likely at the Bank of Canada announcements on March 8th or April 12th. So we're feeling good. This as a mortgage broker kind of cracks me up, and I'm being sarcastic. The last line, OSFI, is sort of the governing body of mortgage qualification and amongst other things. And they're almost like disappointed that the bank is not continuing to increase rates, and are strongly suggesting, and I'm hearing this a lot, that they're going to be tightening regulations for all mortgage seekers to make it even harder. Like, we need that. And so, whatever, we get things done. And again, like this actually makes pre-construction like just an awesome idea from that perspective, because as you alluded to, you don't even need a mortgage right now.
Yeah.
Probably when you do need a mortgage, if you need a mortgage, rates have come down by 2026, 2027, 2028, and things have loosened. But they're always throwing negative news at us, and we just navigate the waters.
Yeah, and I mean that's an important point, because Canada is a cyclical interest rate environment, and we go into recession, or the likes of a recession, and then they ease monetary policy, and they make borrowing money easier again. So I think if you're buying real estate that you want to buy for not to not have to worry about financing, and you're buying pre-construction, maybe 2 years might be too short of a timeline. But when you're buying for 5 years, I think we're going to be in a much easier lending environment at that time.
Yep. So inflation, it's in the news every day, and we're experiencing it in real life every day. It is what it is. Inflation came down in December, and this is what we sort of needed and wanted. And that's why everyone's saying, okay, you know what? In 2023, rates are probably going to stay pretty flat. We're not going to see certainly any decreases to interest rates, but we won't see any increases to interest rates. Remember that. I keep saying that. Remember that for a minute. I get this question a lot, but the Bank of Canada just, so everyone knows, increases interest rates on mortgages, increases prime to fight inflation, because it decreases disposable income. And there are other ways to fight inflation. Some economists would prefer the government did different things, but the fastest and easiest way to fight inflation is to affect the real estate market and cause less disposable income amongst homeowners, because the real estate market is the biggest piece of the pie. It's just the easiest, biggest, and fastest. And I like that word fastest, because it means that, as Ryan just alluded to, we're going to see these spikes, we're going to get the result. And everyone's been suggesting mid-2024 that rates will start to come down, because historically, the Bank of Canada always overshoots it. They raise rates too high, and then, which is sort of where we're at right now. And then it's going to be, a winter of 2024, and they're going to be sitting there going, "Oops, we've definitely improved inflation. In fact, we overshot it. Let's start to bring this back to our target rate again." But everything, in real life, let's talk about real life. Everything's costing more. In a lot of cases, mortgage payments are costing more, food's costing more, gas is costing more. The problem with inflation, there's all kinds of phenomena that impact it. And one of the things the Bank of Canada is worried about, which is a perfect segue into my next slides, is that higher prices will equal workers demanding higher wages, which will equal businesses increasing prices to consumers to pay for those higher wages. So even though they're increasing mortgage rates, there's other phenomena that are sending inflation potentially the other direction, which the Bank of Canada doesn't want it to go. And it's this constant fight. So again, that's why they pick on the real estate market, because it's the biggest piece of the pie that affects the most people. Right. And that last line there on this slide, it won't surprise me if they resume their tightening later this year, but no rate reductions in 2023. Pretty much everybody agrees on that. Next slide. So
It's funny that we didn't agree upon that or on that just even a week ago or 2 weeks
yeah.
ago.
Well, and I mean, I've been hinting at the irony in all of this
Yeah.
is that in January we're saying, basically, we being like the really smart people, I call them, the economists, the propeller heads, they're saying that there'll be certainly there'll be no more rate increases in 2023, and then this labor survey comes out uh, in February, so this month, for the January labor report, and it's really good. Like it's like insanely good. Labor surged 10 times more than expected. 150,000 new jobs.
And do you have any note of, there's obviously a lot of highly skilled people migrating to Canada. I mean, huge population growth. Like, how many of these new jobs are due to that?
Yeah, I don't have any statistics on that, but I can only imagine that it's having a
Because it's
massive.
almost no surprise that they're this is an indicator of inflation coming down when there's job losses, right? And the unemployment rate goes up, but at the same time, we're adding skilled people and it's creating jobs, right?
It's almost like, I know what you're getting at. It's almost like one department's not talking to the other.
Yeah, right. Yeah.
Hilarious. It's like, no, but anyways, labor's back to pre-pandemic levels, and it's basically, this report shows that there's no evidence that the labor market is slowing, and so it is calling into question how long the rate pause will last. I'm like, well, wait a minute. Just last month, the same people told me that the rate pause, we know how long it's like, we're in it. Now we don't know how long it will last, and maybe they're going to raise rates again. Honestly, guys, I'm reporting on all this. I really don't worry about all of this because we still have great mortgages out there, and fixed rates, which I'm going to get to in a minute, are still in a really good place, I think, certainly for investors. But it is what it is, and we might now see a few more increases in 2023, even to the rate, a quarter point here or a quarter point there. I hope not, but maybe. The last line on this slide there.
Sorry, this slide?
No,
Sorry.
that one, yeah. Last line there: if inflation continues to decline as expected, the rate pause will hold. But if not, ... Our economist is suggesting, maybe in March or April, we'll see a few more increases. So what's the impact on the mortgage market? Like, going out and qualifying for a mortgage or dealing with the mortgages we already have. Many of us on this call are probably experiencing things. Maybe we already have an investment portfolio. Things have changed a little bit. Maybe we don't have an investment portfolio, but things have changed in our primary residence. This is just a quick rundown of just the stark reality of what we're dealing with on the mortgages that I, along with my peers, dole out. So as I've mentioned earlier, prime is at 6.7% right now. And conventional variable rates, there's not a big discount right now. So variable rates I'm going to be honest, always recommended variable rate mortgages. Had them myself, and statistically, variable always wins. If you really want to get into statistics and look at a 30-year history of mortgages in Canada or something like that, variable beats fixed. But we are in a very strange period of time, and I like how Ryan is taking shorter term fixed rates, for example, to get us through this thing, because they're so much lower. If variable rates, if the bank is offering a really big discount, like 1% or minus 0.9 or minus 0.8, sometimes we were minus 1.1. We had those back a few years ago and even last year. If you have one of those, well, you might hang around. If you're at prime minus 1 right now, you're at 5.7, and you're right in the mix with where sort of fixed rates are. And you might wait for prime to start to come back down again in mid 2024. But right now, you go to get a variable rate mortgage, and it's, if you just want to go back to that slide, Ryan,
Oh, sorry.
you're at prime minus zero point 0.2 or something, or zero point 0.1. Your rate is in the high sixes. Fixed rates came down, as I mentioned. We're ranging right now, depending on what you're doing, between 5 and 5.5% in most cases for fixed rates. Owner occupied properties, you can get into below 5. Home equity line of credits, those rates have really increased. Prime plus a half on a lot of line of credits, and so you're at 7.2. And through all of this, when you're qualifying for other mortgages, a lot of banks are now qualifying clients on the limit of the home equity line of credit, not the balance, which is the way it's always been. Like if you were carrying a balance, and it gets a little tricky. And so the combination of the high HELOC rates and the tough qualification criteria is, and rightly so, is making a lot of people consider taking equity out in the form of cash. I think that's what Ryan's been doing. Traditionally, investors always like to come into the office and say, I need a HELOC. Ryan Coyle told me to go buy properties with my equity. But now maybe the smarter decision is a 5% mortgage with a few $100,000 in cash deposited to your bank account. And now you're making deposits on things versus, and we weigh the pros and cons and what your needs are and the whole bit, but you're definitely paying a lot less interest, and it's easier to qualify for things. And then that stress test, for anyone that's heard of it, it's at an all-time high. And it's just making my job more difficult, but we have lots of options to get people into mortgages. A lot of this has to do with the leverage Ryan's been talking about, because certainly if you're putting down deposits on pre-construction, you don't need to worry about any of this. You don't need a mortgage right now. So that's kind of cool.
It really makes it easier. I'm buying pre-construction right now, but I've got, I think you've got me 3 to 4 mortgages in the past 2 or 3 months. So it's, it's certainly slower and a little harder, but it's still available.
Yeah, get them done. So what does this mean for real estate investors? Just remember what I said back in the beginning. For a lot of real estate investors, I believe there's more opportunity in 2023. Ryan was alluding to assignments and some great pre-construction opportunities. No mortgage needed now. Well, for some real estate investors, they're literally dealing with reduced or negative cash flow right now. If they were listening to Ryan, it's probably not why they are into the investment, and rightly so. But we have solutions to help with that in the short term. I think you need to be open-minded and creative in these times. Not to embarrass Ryan, but he is very open-minded and creative to just getting transactions done as he builds out his portfolio. You can't be closed-minded. This is different than the way you approach your primary residence mortgage. It's just really different the way you need to think. And you need to have multiple mortgage acquisition partners. I'm not shy to say that. You need to know a couple bankers. You need to certainly work with a good mortgage broker and have multiple resources, because it just helps you build out your portfolio. And
that's a good point, because and you touched on assignments as well. So there are a lot of opportunities in the market right now. I like pre-con because you've got that time value of money, right? And the leverage and the no mortgage. But assignments right now. So the assignment deal you helped me with, I came in, scooped up a property at a discount. I got a private mortgage on it to be able to close on it. But then I had you come in to refinance it, get the appraised lift at today's price. So I bought it at the contract price with private money, which cost me a little bit for 30 days. But the equity lift was so big on it that it's like, that's a dream deal. Like, if you've are able to do that several times in a market, it's a really good thing. And, I don't want to sugarcoat like what this is. It is very challenging. Our cost of living has gone up. interest rates have gone up. It's impacting some people more than others. I'm simply saying there still are opportunities, and there are alternative ways to getting financing. And to your point, you have to get a little bit more creative and work with be more open-minded, right?
You have to have an investor mentality, and it's sometimes not all about you know, that initial mortgage deal, that initial interest rate, when you're looking at the gain, like say on that assignment you just described. And it's a pleasure to work with people that have an open mind to just getting things done, because you can really help them build out a pretty amazing portfolio by getting creative. There's 5 major banks, but there's 90 huge, like, Charter 1, Schedule 1 bank mortgage lenders in Canada that do all kinds of different things that we can tap into. Next slide, Ryan. So very quickly, for those of you that have ever heard me before or worked with me, I think it's never been more important. I'm very pro what I call pre-positioning for investors. And what pre-positioning is, it's kind of like a pre-approval, but you really haven't eyed up a property yet. Whether you own 1 property or 3 or 5, we go through an exercise where we take a look at everything, kind of get you set up. So if you own a couple properties, how are we going to acquire the third, or how are we going to acquire deposit monies on 3 or 4 pre-construction projects? How can we improve what we currently have, getting everything locked and loaded and organized so that we're prepared to make moves and do things. So it's not always like a knee-jerk reaction. Pre-positioning is very, very important, and it's a low-key exercise that no one's expecting you to produce an offer to purchase tomorrow, is what I'm trying to say. So I highly recommend getting organized that way. We have the ability to fix cash flow issues with equity, another form of leverage. I can tell you a story about a guy who purchased a pre-construction condo. He closed on it with a traditional bank mortgage. Good for him. In goes the tenant. It was a variable rate mortgage. The property was worth way more when he bought it than when he closed on it than what he paid for it. But he just did the normal mortgage based on the original purchase price. And then the past year happened, and he had a variable rate mortgage. And now he felt like, he was every month he was underwater. I can't remember, $500 or $600. So all we did was we took a look at that, and he wanted to lock in anyway, so we locked him into a much lower, I think it was a 2-year fixed rate, so instant improvement. But at the same time, we pulled out some equity, which allowed him to invest in another property, but he kept about $30,000 in the bank account to offset the shortfall. So now his tenants are paying that mortgage, by the way, but now that shortfall is not impacting his monthly paycheck from his job.
Yeah.
Obviously an investor on a smaller scale today than Mr. Ryan Coyle, but
that's exactly what I do.
What a great solution.
Yeah. And that's exactly what I do, just on a larger scale, but that's it.
Alternative lending solutions. We keep touching on that. You got to be open-minded. I always tease the realtors when I'm doing presentations to large groups of realtors. I always say, why did you guys start calling alternative banks B lenders? Everyone's running around now calling them B lenders. It sounds like second place. They're great full-featured mortgage solutions that can get the job done and really help you build out your portfolio if we're getting some resistance from the major banks. That's a little plug for alternative banks. And then, we got to have that conversation about fixed versus variable, HELOC conversion. If you're carrying large HELOC balances, converting it to fixed rate mortgages while you're pulling out more equity, yada, yada, yada. I mean, the list goes on. I just wanted to point out a few things that come up during a pre-positioning consultation that might help you. And I think that's it for me, right?
It is. I know we have a lot of questions. They're going to pop up in a few minutes. Before we take to the questions, this is just such a basic slide here, but I think it's really important. I talk a lot about GTA real estate and the Toronto condo market, and this is the Webster's Dictionary definition of supply and demand: the amount of goods and services that are available for people to buy compared to the amount of goods and services that people want to buy. If less of a product than the public wants is produced, the law of supply and demand says that more can be charged for that product. The reason why that is so important is because this real estate market is not all that complicated. I've been saying this for the last 20 years. It is simple supply and demand fundamentals. I invest my money into a product that I know has very low supply and very high demand. And that is always the number one indicator as to why my investment will do well. Again, there's going to be ups and downs like any stock, any real estate, anything, but the Toronto condo market, real estate market is so set for such supply and demand fundamentals. We're not going to get into any of this tonight, but on our next presentation, when I give more of a market update for the year and market forecast, there's headline after headline about the shortage of homes based on construction restraints, dwindling construction starts, completions, but rising demand through immigration. So it's not all that complicated, is my point there. So yeah, I guess we'll jump into some Q&As. I'll keep this slide up. So those of you who want to reach out to me and my team and Adam and his team, our email and phone numbers there. That's Adam's home line. So feel free to call him anytime. He loves calls.
Yeah, any hour.
I think I can't see the questions. I think someone's going to pop them up.
Oh, I see.
There we go. So real estate is a long-term investment. I actually just lost it. I can't see it. Oops.
As real estate is a long-term investment, does age of the first-time investor become an issue? In brackets, 57.
I see. I'll take a stab at that first. So, I mean, look, it really depends what you want. So real estate, some people do invest for cash flow because they may want to retire at a certain age, and their goal, they work backwards. They want to have, $200,000, whether that's through monthly cash flow or that's through equity in a few years. It really is a bigger question than what you're asking. And I'd love to, reach out to me direct, and I'll break it down for you once I know what you're really looking for. But it's never too late to invest in real estate. It depends how much equity you have right now as well. If you bought one condo today, you'd be ready to refinance and buy another one in 5 or 6 years. If you could buy 2 condos today, that's going to happen a lot faster. So I like to always start at the end. I want to know what your goal is, and then I'll help you accomplish it. But it's never too late to buy real estate. I mean, some of my best clients, David, you're probably listening to this, but I won't say your age, but he's older than you. And he's got a crazy portfolio. He's got 14 properties right now. I know, Adam, you work with him, and he pulls out his equity and he buys more, and he uses that for his cash flow to live because he's retired, and he'll be passing on his portfolio to his children.
Yeah, I mean, my comment on that is sort of along what you said, Ryan. I'd love to do a review of where things are at now to determine, how fast and furious we can go if interested. But 57, that's the new, isn't that the new 37 or something? Like, I mean, 57, I mean, 20 years from now, you're 75, 77 exactly. But,
you do a lot.
You can do a lot in that amount of time. And I hope that I'm still in the real estate market when I'm in my 70s, for sure. Want something to give to the kids and their kids.
Yeah. How would I qualify for the mortgage loan to close on a pre-construction condo when construction is complete? Aren't maximum loan amounts based on income and debt ratio? I'll let you take that one.
Yeah, great question. So anytime someone's going to purchase a pre-construction, Ryan's team sends them my way, because the developers have a condition that you need a pre-approval letter, and we fire those off all the time. We don't take that. We can get them to you quickly to satisfy the developer, but we take it seriously. We take in your application, and we do a full review as if you were going to maybe buy it tomorrow.
I think he might be asking that, Adam, because he wants, how do I qualify for the mortgage loan to close?
I was just going to say, so If we feel that when we do the intake that application that you might not qualify for the mortgage the traditional way, we talk about all the other ways that you can close on the condo, take advantage of the capital appreciation through alternative lending or private lending. A big part of it is if you have your deposits, we can often produce a mortgage. It might not be a traditional mortgage from one of the major banks, but we can help get it done. It's very case by case, and then you make your decision. Is this something you want to do or not? Where there's a will, there's a way.
Yeah, I mean, there's always a way. I mean, the important piece, I think, as well is that as long as there's equity, I mean, you'll be able to find financing, and that's why you don't want to buy something pre-construction that's ready in a year if that's your big concern. Financing, look for something that's a little bit longer out. You'll build more equity by the time you actually close. You're going to be in a really good position. David, again, our mutual client, he doesn't have a job. He's long retired, and he's buying condos. So there's a way. So it depends. So typically when you're buying pre-construction, I always like to use the example. So you've got a pre-construction condo building that just went for sale here. Across the road, you've got an existing condo building that is new. And I say new because that's important, because if the condo market's appreciating at 5% per year, that's made up of old inventory, that's made up of new stuff. Old stuff will appreciate at a lower amount. Newer inventory will appreciate at a higher amount, so maybe 7 or 8%. So, when you're buying a new building, pre-construction, the existing new building across the road might be 10 to 30% cheaper. So you're paying a premium for pre-construction. But again, you're getting the higher appreciation value on the newer condo. So it'll appreciate at a higher, faster rate than existing condos. But you have to be careful with that number. So, if you're buying a pre-construction condo with a 5% deposit deal that's ready in a year, you might be paying 20% above market value. That's a risky investment because you're assuming the market's going to appreciate 20% in a year. So I talk often about the time value of money. You're buying pre-construction a bit of a premium, but over 5 years, you're going to be building up a ton of equity by the time it's actually completed. And there's nuances to that as well. I mean, Forma, for example, I paid $1,900 a foot. There is a few very high-end buildings that have properties trading at $1,900 a foot. So I feel like I bought at market value for something that may not be ready for 8 years. And those deals do happen. And in this market, we will see more and more of them. You want to take that one, Adam?
Is refinancing based on the purchase price or the current value of the property? And does there need to be a certain amount of the original purchase price paid?
I think he's referring to pre-con, so probably, yeah.
Yeah, so that's a great question. So when you're going to arrange the mortgage for final closing on the pre-construction condo, it's time. That's when we start to talk about the various choices you have. If we qualify for and we want more of a traditional mortgage, we're not at that time pulling out any equity or anything like that, and so on and so forth. Then the banks, they like to lend based on the original purchase price only, and you've made your deposits and away we go. A lot of investors, if it's been like a 4-year hold or something like that, and the value is much higher, get an appraisal done. It's appraised at a much higher price. We can work with some other banks and such to get you a mortgage based on the actual appraised value, even on the day of closing. So imagine your property's gone up in value, and we're able to arrange a mortgage on final closing that's large enough that you get all your deposits back, plus some extra money, and now you have a mortgage on that property with some tenants in it. Boom, and now you're cycling your deposits, and you're going to get another one.
Yeah, those are infinite returns.
Mm-hmm.
I'm not having paychecks coming, but have properties with enough equity. Can I still be able to add more properties to grow my portfolio? I'll say yes, and I'll let you get technical on why.
Well, well, in short, the answer is yes. You have to be open-minded and be open to working with other mortgage solutions. Keep in mind these are all good mortgage solutions, but we keep you know, picking on our mutual client David. I'll say it again, like David, what does he have? 14, like
14.
insane amount of properties now, and isn't currently working. He's retired. So if where there's a will, there's a way. I'll just say that.
Yeah, I can touch on that. So, can you further explain your point on how refinancing is tax deductible? So, you don't pay taxes on a property until you actually sell the property. So, if you keep that property in a family trust for the next 100 years, you could keep refinancing that property and taking equity out, and you're deferring. I mean, you're not even paying tax on it. So, you're taking it out and you're not paying tax. When you go and sell the property, you will pay tax on your original purchase price and the difference between what it's worth at that time. Can you explain what an assignment is? So an assignment is a purchaser bought a pre-construction property condo. The original purchaser then assigns their interest in the contract to a new purchaser, and you essentially cross out the name of the old person, you add the name of the new person, and they take over the obligation of the original contract. Now, the way that typically happens is the original purchaser, the assignor, is the seller, the assignee is the purchaser. So the original purchaser, the assignor, put down a deposit, and they typically want to make a profit. So the assignee comes and makes an offer. They pay them back their deposit, and their profit can be paid either before final close or after final close, depending on how the deal is negotiated. And then you take over the property. Now, in this market, given the challenges with financing currently, I have never seen so many opportunities to buy assignments in this market. There is an incredible opportunity to, I don't like saying take advantage, but I mean, you're really, I mean, you're kind of helping people and taking advantage of a situation where you can take people's contracts where someone may have put $100,000, $200,000 deposit, and the property's maybe up 200, 300K. They're walking away from the deal. They want their deposit money back, but you could put down maybe 50,000 until the property closes. And then you'll take out a mortgage based on 80% of the equity, and you'll be able to pay them back their original deposit and then take over the property, probably without putting any money into it, depending on the numbers. But those are the type of opportunities there are in the market right now. We have access to probably hundreds of assignments currently available.
It's instant equity. And there's lots of reasons people decide they need to assign a sale, right, Ryan? Like, I mean, life happens,
Yeah, of course.
couples break up. I mean, there's all the life factors that factor into it too. It's not just because they're struggling acquiring a mortgage, but those that are probably just speaking to one bank. I'll tell you that. But Ryan's right. There's a lot of opportunities out there.
Yeah, no, that's a good point. Thank you for correcting me on that, because and you know what, that's probably the scary thing. And I think we probably have some people watching tonight who may think they're in the same situation. And you don't have to sell your property. If you have equity, you're going to get financing as a way. How much do you have to earn to buy another house? I mean, I think there's a lot of nuances.
Yeah, that's a pre-positioning consultation in the making right there, right? Because every situation is different. So I usually tease my friends and clients. I always am very vague and just say, look, I mean, I'm not going to know until I take a look at it, and I really push for that because every situation is different. There's no magic number, but have someone review your situation. I bet you it's probably good news.
If you purchase pre-construction and close on it, how many years later should you keep it for? In other words, when does it lose value where you could put your money else to gain more? So yeah, this is a tricky question. I've kind of played with this dilemma for years, but where I've landed, Trish, is that it's always better to refinance, take the money out, don't pay tax on it, and redeploy it somewhere else. Now, there is a point usually around the 7 to 9 Well, I mean, depending on the condo, maybe 5 to 7 year mark where the appreciation starts falling below the average annual appreciation for a condo, right? Because I mentioned earlier, newer condos appreciate at a higher amount, older condos appreciate a lower amount. But what you have to remember is when you sell a property, you're paying tax. So the after tax money that is left in your pocket to go buy another property, you need to look at that, because often you can refinance, not pay tax on it, go use that money to go buy more real estate and still keep your existing property that your tenant will pay that mortgage. It won't appreciate at the same amount, but you're still left with more money to redeploy and you still hang on to that asset. I think both of our services are free. I represent investors and real estate buyers. My team does as well. So, this is passion for me. You guys see my portfolio. I don't want to sound, obnoxious, but I really don't have to do this anymore. I love what I do, and everything I do for my clients is what I've figured out for myself. I've figured out these things and I keep figuring them out, and I keep sharing that information with you guys, and I keep meeting people like Adam that help me and then will help my clients. So I really love what I do. I don't do it for free. I'm compensated by builders. They compensate us, but we represent the buyer and the investor and get compensated by the builder.
Yeah, same goes for me, Alvin. As a modern day mortgage broker, generally speaking, my services are entirely free, and certainly from the standpoint of, like you've heard me mention, pre-positioning consultations and helping you plan things out. And then if I do a good job and earn your business, the bank pays me for arranging the mortgage. And in some circumstances, we end up arranging, institutional private mortgages and things like that to solve a problem or help obtain a goal. And then a good broker will always tell you up front that they might have to charge a fee for that, but it would be well in advance of you making any decisions. And that's only because private investors don't pay brokers like a bank does. So that's as precise I can be. 97% of the time, a modern day mortgage broker services should be free to you.
All right, Adam, it's getting late. Let's take 2 more questions if that's cool, and then we'll call it.
Almost my bedtime.
Is it better to buy pre-construction or already built? I think, Lynn, the best thing to do is reach out to my team and we'll look at your situation and we'll figure it out. Look, if you want to build a large portfolio and scaling, depending on how much capital you have to invest now, pre-construction, and depending on your timeline, pre-construction is probably the best avenue. Again, there's some opportunities in the market where you could buy houses and you can turn them into, rooming houses. There's a lot of options, but, I don't know if you saw the beginning of this webinar. We'll certainly send it out to everyone, but pre-construction, I think, is the best, safest, and easiest way to do it, but you need time. All right, last one. I would like to know lucrative projects which are just 5% deposit till closing. Well, you're in luck. I just talked about project.
That's awesome.
It's really important to know. So typically when you see a 5% deposit, which is rare on its own, you're buying something that's ready in 1 year, maybe 2 years. And you got to watch out. Like I said, sometimes pre-construction is priced higher than resale prices. So you want a longer runway to really tap into the appreciation and the leverage on the other 95%, right? So I just gave an example in this presentation. We'll send you a recording, but I bought a $1.9 million condo. I put down 5%, which is $100,000. I won't put anything else down for 8 years. I mean, 6 to 8, but I expect 8 years. And I will make a lot of appreciation. And in fact, if I do non-traditional financing with Adam, I don't actually have to put down any more money because I'll be able to get financing based on the market price at that time. I'll get a big fat check and I'll own a nice condo. So that important piece is the time value of money. And then Television City in in Hamilton is a great building. I bought a number of units in there with 5% down. It's 5 years out. You could buy a property in there for as low as, I think, $20,000, $25,000, 5% of the purchase price. and nothing else. And alias condos, we'll actually probably send those opportunities out in this email when we send the recording. But alias condos, stunning project in downtown Toronto, 5% deposit, 4 years out. So lots of opportunities. Just reach out to us. All right. Well, I think that's it, Adam. Appreciate it. I took a lot of your evening, but I love chatting, and you know,
I learned something every time. You fired me up.
Yeah, cool. Well, you know, I know you're. We'll be talking soon anyway. I think I got some refinancing money coming from you any day now, so we'll be in touch. And thanks again.
Thanks for having me, Ryan, and have a great night, everybody.
Good night, guys.